Welcome to Iron Financial. This is the workshop where we forge stronger portfolios by stress testing companies and cutting through all the market noise. Today, we're putting a big one under the microscope. Hubbell Incorporated. We're going to kick the tires, check the welds, and inspect the load-bearing walls of this industrial giant to see if it really has the strength to earn a place in your portfolio. I'm your lead analyst. Let's get to work.
And I'm your market skeptic. You know, in a market this choppy, this unpredictable, everybody is out there searching for the same thing, a safe harbor. They're looking for real, tangible, industrial-grade strength. We're on the hunt for those companies that are truly load-bearing, the ones that are actually holding things up when it feels like everything else is starting to crumble. So the big question on the table today is, Hubbell forged from that kind of steel? Or is it just another company with a really good story and some slick marketing? That's what we're here to find out.
So here's how we're going to do this. We're conducting a full structural inspection, top to bottom. First up, I'm going to forge the bull case. I'll lay out all the reasons this company looks like a fortress. Then, my skeptical colleague here is going to grab his hammer and start searching for cracks in that foundation. After that, we're going to pull out their 2026 blueprint to see where they plan on building next. And finally, we'll deliver our verdict. Is this company truly built to last?
All right, let's get right into it. Section 1, Forging the Bull Case. Look, the argument for Hubbell, the evidence, it starts with the raw, undeniable power of their recent performance. But it's not just about the numbers themselves. It's about the massive macroeconomic forces that are pushing them forward. This isn't a fluke. This is a strategy meeting a moment. First things first, you have to understand exactly what Hubbell does. This isn't some flashy, high-flying, speculative tech stock that's here today and gone tomorrow. No, this is the heavy iron. This is the nuts and bolts. Hubbell is quite literally the backbone of our electrical grid. They manufacture the essential, non-negotiable, mission-critical components that our entire infrastructure depends on to function. We are talking about the biggest, multi-decade megatrends you can think of. Modernizing our ancient power grid, the electrification of, well, everything, from cars to homes, and the absolutely explosive growth of data centers thanks to AI. Hubbell provides the guts that make all of that possible. They are the picks and shovels in a 21st century gold rush.
And speaking of performance, they just turned in an absolute monster of a quarter. The chairman and CEO, Gerben Bakker, he led their latest earnings release with this quote right here, and I want you to listen to the words carefully. Hubbell delivered double-digit growth in net sales, operating profit, and diluted earnings per share in the fourth quarter. Think about that. Net sales, operating profit, EPS. That's the trifecta. That's a grand slam. When a CEO can lead with that kind of comprehensive strength, it's not just good news. It's a powerful statement of confidence, execution, and market dominance. Okay, so let's break that down. The first pillar of the bull case, the crucial starting point, is the top line. We're talking a 12% jump in Q4 net sales year over year. In the world of heavy industrials, that's not just steady growth, that's hitting the accelerator. That's powerful momentum. And here's the best part. 9% of that was pure, unadulterated, organic growth. That means it's not from some fancy acquisition making the numbers look good. It's their core business, selling more stuff. And what's driving it? They're telling us it's exceptional data center demand and sustained grid infrastructure investment. Their core markets are on fire, and Hubbell is right in the middle of it, supplying the critical parts. And this slide right here, this really puts the scale of that growth into perspective. This isn't some small cap company putting up big percentages on a tiny revenue base. No way. They went from over $1.3 billion in sales in the fourth quarter of 24 to almost $1.5 billion in the same quarter of 25. That's an increase of over $158 million in revenue in a single 3-month period compared to the year before. That's some serious heavy lifting. That's the kind of raw power that gets Wall Street's attention. But here's the thing. It's not just growth for growth's sake. They are getting more profitable as they get bigger, which is the holy grail. Look at this. 140 basis point expansion in their adjusted operating margin just in the fourth quarter. Now, this tells me two absolutely crucial things. First, it tells me they have real pricing power in the market. They can pass on higher costs and then some. Second, it screams that they are running their operations with ironclad discipline. They are squeezing more profit out of every single dollar of sales. It's a testament to incredible management. They aren't just growing the top line, they're fortifying the bottom line. And of course, it all flows directly to where it counts most for us as investors, the bottom line. 15% growth in adjusted earnings per share. Let's just be crystal clear about what this means. This is the triple crown of a powerful earnings report. You have strong top-line growth, you have expanding profitability and margins, and it results in explosive earnings growth. When you put all these pieces together, on the surface, this bull case doesn't just look strong, it looks absolutely bulletproof.
Whoa, hold on a second. Bulletproof? Let's not get ahead of ourselves and start commissioning a statue. The headline numbers, they look fantastic. I will absolutely give you that. But any good engineer knows a strong facade can hide a weak foundation. So it's my job to start tapping on the walls, checking the stress points, and looking for fractures. It is time for Section 2, searching for cracks. My cross-examination begins right now. Okay, so those growth numbers are impressive, I'll admit it. But my very first question every single time is always the same. What's holding it all up? Where's the money coming from? Is this beautiful structure they're building founded on the solid bedrock of internally generated cash flow? Or is it being propped up by a rapidly growing mountain of debt? Because, let's be honest, leverage is a powerful tool. It can make a company look incredibly strong, right up until the very moment it collapses under its own weight. We have to look at the balance sheet. And here we go. First tap on the wall, and we find something interesting. Look at these numbers, pulled straight from their own balance sheet. Total debt. It jumped from about $1.6 billion to over $2.3 billion. That is a nearly 50% increase in a single year. And look at their debt-to-capital ratio, a key measure of leverage. It climbed from 32% to 38%. So this growth isn't free. It's being fueled by leverage. It's being paid for with borrowed money. Now, the critical question for any serious investor is whether this is a sustainable strategy or if they're simply borrowing from the future to make today's report card look good. This isn't a minor tweak. This is a significant strategic shift towards a much more leveraged profile, and that adds a layer of risk that simply wasn't there 12 months ago. Okay, next crack I want to examine is about language. The word adjusted. I've heard it a few times now. Adjusted operating margin, adjusted EPS. As you can see on this slide, these are what we call non-GAAP metrics. This means the company takes the official audited numbers, the ones that follow generally accepted accounting principles, or GAAP, and then they start pulling things out. They exclude certain expenses that they decide aren't part of their regular business. Now, the company will tell you this gives you a clearer picture of their underlying performance. But a skeptic, like me, says it's a way to airbrush the ugly parts out of the family photo. You have to look very, very closely at what they're choosing to exclude, because what they consider non-regular can often be very real, very recurring costs of doing business. And this slide right here shows you exactly what I'm talking about. Their official, by-the-book GAAP net income for the full year was $887 million. But their shiny adjusted net income, that was a much rosier $977 million. That's a $90 million gap between reality and their preferred story. So what are they excluding to create that gap? Well, look at the key items. Nearly $110 million for amortization of acquisition-related intangibles, and another $7 million for transaction and integration costs. These are not imaginary expenses. This is real money going out the door related to the very acquisitions that are fueling some of their growth. Stripping them out to present a prettier adjusted number is a classic yellow flag. It's a way of saying, hey, pay no attention to the full cost of our growth strategy. Just look at these shiny results over here. And finally, let's probe deeper into the actual operations. While the headlines are all talking about booming, explosive demand, it's not a universal truth across the entire business. If you dig into the earnings call transcript, management specifically mentions continued softness in grid automation, and their own presentation data shows it plain as day. Within their massive utility solution segment, the grid automation subsegment was down a jarring 8%. Now, that is not a rounding error. That's a significant decline in what should be a key technology area for the future. So the bull story of firing on all cylinders just isn't entirely accurate. There are parts of this big, powerful engine that are clearly sputtering. Okay, those are all valid points. We've looked for the cracks, and you've found a few. Now let's look forward and examine their plan to build higher despite those issues. This brings us to Section 3, the 2026 blueprint. The question is it a credible roadmap for the future, or is it just a risky bet?
So management has laid out a very clear blueprint for the year 2026. They're guiding for 7 to 9% total sales growth. They see their, yes, adjusted, EPS landing somewhere between $19.15 and $19.85 a share. That's nearly 10% growth right at the midpoint. And, crucially, they're committing to strong free cash flow conversion of around 90% of that adjusted net income. This is not a company that's signaling a slowdown. They're out there promising continued robust and powerful performance. This guidance suggests that they believe the massive tailwinds in their markets are strong enough to power right through any of the weaknesses or soft spots my colleague just highlighted.
And what's important here is that this expected growth isn't coming from just one place.
When you break it down, they're projecting pretty balanced organic growth across both of their major divisions. They see 5 to 7% from utility solutions, that's the grid-focused part of the business, and a very healthy 4 to 6% from electrical solutions. This suggests the foundation for their future growth is broad and diversified. They aren't just relying on a single hot market like data centers to hold up the entire structure. For a well-managed industrial company, that kind of balance is a very good sign.
Okay, I'll admit, that blueprint looks pretty solid on paper. It's detailed, it's confident, but you know what they say? No construction plan survives first contact with reality. You can't just admire the blueprint. You have to look at the terrain it's being built on. And what happens when you factor in the single biggest risk, the biggest sinkhole for any industrial company right now? Relentless, stubborn, and unavoidable cost inflation.
And there's their answer, right from the source. They plan to offset mid-single-digit cost inflation with their own price hikes and productivity actions. Now, that sounds great in a PowerPoint presentation, doesn't it? It sounds neat and clean, but is it a guaranteed defense? I mean, really, can they keep raising prices on their customers indefinitely if the broader economy starts to soften? Pricing power is easy to claim when the market is strong and everyone's buying, but it gets brutally tested when things turn south. If that exceptional demand from data centers cools off even slightly, or if a hungry competitor gets aggressive on price, this neat little equation of price hikes will offset inflation can fall apart very, very quickly. This is a major external risk that hangs over that entire blueprint.
And that is the critical question, isn't it? That brings us to our final weigh-in. We've seen the strengths, we've examined the weaknesses, we've looked at the plan. It is time for Section 4, the verdict. Let's put it all together on the scales and decide if Hubbell is truly built to last.
All right, let's put it all on the table side by side. On one side, you have the foundation, and the bull case here is powerful. You have undeniable demand from huge megatrends like data centers and grid modernization. You have impressive margin in EPS growth. You have a confident outlook for 2026 and high free cash flow conversion. But then you look at the other side of the ledger, the fault lines, and the bear case is just as clear. There's a significant, almost 50% increase in total debt in just 1 year. There's a heavy reliance on those adjusted, non-GAAP figures to paint the prettiest picture. You have real pockets of weakness, like that 8% decline in grid automation. And you have the constant external risks of inflation and supply chain issues. These are not small things, these are real risks.
So here is the verdict from our workshop. Hubbell is fundamentally plugged into some of the most powerful, secular growth trends of the next decade. That's undeniable. The demand for their products isn't just cyclical, it feels structural. The company's operational performance is clearly strong, and management has laid out a credible plan. Now, the concerns are real, especially that debt load. That is something that has to be monitored very, very closely, quarter after quarter. However, the core business is an absolute cash-generating machine, and that strong, consistent cash flow is the ultimate tool for managing a debt load. It appears more than capable of servicing that debt while still investing for future growth. The foundation seems solid enough to support their ambitious blueprint, but it is not without risks that require careful and continuous monitoring from any potential investor. So we've taken it apart for you and we've put it back together. The final question, as it always is here at Iron Financial, is for you to answer. We've shown you the strong, forged steel of their core business model, and we've pointed out the potential stress fractures in their balance sheet and their reporting methods. So, is Hubbell a piece of industrial-grade iron, ready to be a core holding in a truly durable long-term portfolio? Or will it be the company that cracks under the next wave of economic pressure? Do your own diligence. Stress test your own assumptions. That is the only way you forge a portfolio that is truly and without a doubt built to last.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.